Here we go. Are you ready for part 2? And part 2 is talking about cash dividends, stock dividends, and stock splits. And we're not going to spend an extraordinary amount of time on these, but I want you to understand what exactly they do. So, let's begin. So, how are dividends and stock dividends accounted for? They're simply all distributions to your stockholders, and they can be in the form of cash, stock, or other property. And legal capital refers to the portion of the stockholder's equity that cannot be used for dividends. And there are restrictions on retained earnings that say, well, you can't distribute retained earnings below this point, because always dividends are deducted from retained earnings, remember that. So there can be restrictions on when and how much you can give out for dividends. So there are 3 dividend dates. One is when they declare it, and that's when they announce the intention to pay the dividend, and a liability is created at that time. Date of record, this is the date the corporation records the stockholders that will receive the dividend checks at that point. And then the payment date, obviously, is when it's paid. So there are 3 dates. This right here is not recorded in a journal. It may be done in a memorandum, depending on how the company handles it. But there is no actual journal entry for that. And the next thing you've got going here is when you declare a dividend. You literally say cash dividends is a debit for how much per share, whatever's outstanding right now. And then it becomes a payable right here. That's what they say when they make the liability. So there's going to be cash paid out eventually of $1,135. Then when you pay it, you take it out of the payable and pay it out of cash. And ultimately, when you close at the end of the period, it comes out of retained earnings. So let's move down. Now here, when you're paying a stock dividend for when you're paying a dividend for preferred stock always gets paid their dividend, usually, and it can be cumulative, preferred, or it can be non-cumulative. Now the difference between the two is cumulative. They get paid every year, whether there's a stock dividend declared or not, and that accumulates. So when a dividend is paid, that all of that amount of that stock that is accumulated will be paid before common stock receives their dividend. Non-cumulative simply means if there's no dividend paid, there's nothing accumulated. But when there is a dividend paid, preferred stock gets their dividend first before common stock does. So there are 2 types. And here's an example. Preferred stock is cumulative, and they didn't pay any cash dividends in 2016. If they had paid dividends, it would have been $3,000 to the preferred stock first. So in 2017, they declare a dividend of $50,000 total. So this is kind of what it looks like. Total dividend is $50,000. They're going to pay that 2016 $3,000, and they're going to pay the 2017 $3,000 for a total of $6,000. Because this one, whether the dividend happened or not, is owed. So when you get down to the bottom, this is the amount that is left for the common shareholders, and that's what will be distributed among the common stock. Now, a stock dividend is a distribution of stock. It affects only the stockholders' equity accounts and has no effect on stockholders' equity. And there are no effects on assets or liabilities, where a cash dividend reduces assets, right? Because you're paying cash out. So why do they issue stock dividends? Well, it continues dividends but conserves cash. So if I distribute stocks and I have poor cash flow, I'm still continuing my dividends. I'm just not paying it out in cash. It reduces the market price per share, and it rewards the investors. It keeps them coming back for more. And how do you record it? Same way you record the cash. You have a declaration date, a record date, and a distribution date. A small stock dividend is less than 20 to 25, and a large one is more than 20 to 25. And the difference is the small stock takes the market value. The large stock dividend takes the par value. So here's recording stock dividends, and this one is a small one, evidently. This is market, and yeah, it's a small one because it has additional paid-in capital right down here. And it's saying, or issued and outstanding, market value is $50, and the par value must have been $1 maybe. I'm not sure. It's not showing us here. 50, yes, is $1. So here you look at it. This is the amount of the dividends. Right here, it's a debit. This is the amount of the common stock that will be distributed, the numbers, and that's at par. And this is the amount of paid-in capital in excess of par, which gets credited. So this is the declare date, okay? And this is the distributable. This is actually the payable or the liability right here. So when it is distributed or paid, the common stock is going to be credited, and the distributable is going to be debited to take it off the books. So if you look at how it's recorded, here is before and here is after. Now you'll see you've got more paid-in capital. You have $100,000 in addition of equity in common stock, and your retained earnings is $5 million less. So it's just kind of shifted things around. Now that's a small one. I don't believe they show us a large one, but a large one would just be using that par value, because you don't want to skew the paid-in capital with a very large distribution of stocks. As you could see, it could very well be. Stock split is different than a stock dividend. It simply increases the number of stocks and decreases the par value. So it's a relatively painless type thing for the equity section. This is just a really interesting, it shows the effects of each one. And this one area right here has an awful lot to do with dividend policy, because you can see if you don't want to decrease your assets, then you're going to do a dividend, a stock dividend, or a stock split. If you don't want to affect anything, but you still want to reward your stockholders, you're going to do a stock split, because that's going to give them more stocks, and as it builds up market value, then they will have an increase in equity. So those are dividends, and we're going to look now at net income and equity and how they're reported for a corporation. So a corporation's income statement is similar to a multi-stepped income statement for a sole proprietary, except for it has an income expense, because sole proprietorships and partnerships don't have to pay an income tax, and they don't have income tax. And also the includes a section for both federal and state. Kind of looks like this. So you've got this is our gross profit. These are our operating expenses. Here's our other expenses with interest. And finally down here's our tax expense. So you can see also on an income statement of a corporation that has stockholders, you're going to have and earnings per share. So, and then this is going to talk about the retained earnings statement, and that shows how the retained earnings balance changes from the beginning of the period to the end of the period. And at times you can have a negative amount in the retained earnings, and that's a deficit. So, a statement of retained earnings. If you remember when we were doing financial statements, very second part of accounting 1, you do an income statement, then a retained earnings statement, and then you do the balance sheet, and then you follow that with a cash flow. So we're going to look a little bit closer at the retained earnings here. Here's your beginning retained earnings. We add the net income, and then we subtract or deduct the dividends, and that gives us a new retained earnings for the beginning of the new year. Sometimes you can have appropriations of retained earnings. They can you've got cash dividends and stock purchases requiring a cash payment. You have to kind of look down the road and say, okay, we need to make sure we have this much retained earnings available for if we have to do certain things. And they're retained earnings that are restricted and recorded by journal entries. So just a heads up, appropriations, a lot of times to get a loan, if the company is on shaky ground, there'll be appropriated retained earnings, that the retained earnings can't go below that. It's very similar to restricted. And it is a restricted, but it's appropriations. You have prior period adjustments, which will show up occasionally. If there's been an accounting error that will have to be made, it will go directly to retained earnings. And that will kind of look like this on the statement of retained earnings. Here's your beginning. Here's the prior period adjustment. And there's your net income. And then there's the dividends declared. So that prior period comes right immediately after the beginning. And then this is a statement of stockholders' equity that shows the changes in shares and also reconciles the retained earnings so that you take that entire section and show exactly what's happening in each area of the equity section. And then we move on here and talk about that deficit. If you see a deficit, that usually means the company's on very shaky ground. And this is just another example of a retained earnings. I think I got lost. You think? I think it skipped me. Here's our next learning objective. This is using that earnings per share, return on common stock, which is also called return on equity. And then there's a price earnings ratio, or the PE ratio, that you hear a lot about if you're looking at financial pages. Very simple ratios to use. And ratios are really important because that's how we compare companies. So there's earnings per share, price of common stock, and PE. And the final portion of that income statement, like I mentioned before, usually has this earnings per share. And this is the one most people look at most often. I'm not sure it's the best one, but it's the one that most people look to. And that formula for that is the net income minus preferred dividends. divided by the average number of common shares outstanding. And that means you will take the beginning, the ending amount of, where is it, stockholders' equity here, or shares here. Divide those in 2 to get an average. Add those together, divide them in 2 to get an average to come up with your earnings per share. You're always going to take out that preferred stock, preferred dividends, if there were preferred dividends. Very important. There is an entire chapter on nothing but how to figure out earnings per share, taking into consideration options, share options that are out there, and all kinds of things that could dilute the actual share earnings per share. We're not going to get into that, but do know that this should be at the bottom of a corporation income statement and how to figure it. Here's the price-earnings ratio, and that is looking at the market price of a share divided by the earnings per share. So to get this one, you have to do the earnings per share first. And its ratio looks like this, the market price per share just divided by earnings per share. And it'll give you a ratio of 23.5. What that's telling you, in theory, is for each dollar, how much you're willing to pay for each dollar of the company's earnings. So it's worth 75, right? And each dollar that is earned is worth $23.50, in essence, to buy a share. That's a much watched ratio. And finally, the rate of return on common stock or equity. That ratio is net income minus the preferred dividends divided by the common stockholders' equity, and that's the average. Again, you would take the beginning equity plus the ending equity and divide it by 2, okay? And then divide that into the net income that has stripped of preferred dividends, and that will give you a percent. That's your return on equity. Many watch all of those. Those are 3 big ones. And that takes us to the end of the chapter. I hope this has helped. I'll see you in the assignment worksheets. Please email with questions, okay?